PayPal is down 82% from its all-time high, and in this video, I am going to do an in-depth analysis by looking at the financials of the company, the balance sheet, and using my Excel spreadsheet to see what price you should pay for the company. Starting with the financials, PayPal is a company that has consistently grown revenue between 10 and 20%. They had a spike during COVID because people were buying online a lot, and that growth percentage has naturally come down. But this is still a growing company, and analysts are expecting it to grow between 6 and 10% over the next 4 years. In year 5, they have PayPal growing 20%, but keep in mind that there are only 3 analysts covering it. Their net income has been growing nicely since 2014, although it suffered during 2022, but it has rebounded nicely and it is currently at $4 billion. Keep in mind that during COVID, they managed to reach $5 billion. Their free cash flow has also been growing nicely for the past 10 years. However, contrary to net income, it has suffered this year. They also managed to reach $5 billion in 2022, and I think their net income and free cash flow will continue to grow nicely over the next years. Talking about profit, analysts expect this company to make $9.22 in 2027. If you assign a 15 PE to the company, it would make it a $138 stock, which means 152% upside. Therefore, huge returns according to analysts. So far, the financials look good, but the question becomes, can we pay a good price in order to make a good return on our money? In order to answer this question, we are going to use my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis and did low, middle, and high assumptions. Right now, you are seeing 6 numbers. The top 3 are based on net income and the bottom 3 on free cash flow. These numbers mean 2 things. First, that in order to make the desired annual return that I have put in, you need to pay these prices. Second, if the low assumptions occur, you're going to make a 10% annual return on your money. If the middle assumptions occur, 20%, and if the high assumptions occur, almost 30%. And I think on the middle, I made reasonable assumptions. As I have the company growing at 7% annually, keep in mind that analysts are expecting around 8.5%, 18% profit margin and free cash flow margin, which excluding some years has consistently been between 18 and 22%. The reason I went with the same margins is because free cash flow and net income tend to be the same over long periods of time, and in this case they are very similar. I also assigned an 18 PE and price to free cash flow to the company and left the share outstanding change at 0%, even though they have been buying back some shares. The Excel spreadsheet does not give any value to the balance sheet, and this company has a great balance sheet with $17 billion in cash and 10 in debt. They have very little debt, which is amazing. However, the risk that I have found in investing in this company is competition. There is a lot of competition in the fintech space. However, they have a massive user base of over 431 million, and I believe the reason for this is because they offer safety in the online transaction space. On the other hand, this is a company with a great balance sheet, with good growth and good margins. Most importantly, their valuation is very attractive, as we have seen on the Excel spreadsheet, and they are trading at a forward PE of 10. They also own Venmo, which is one of the most popular finance apps. I think this is a well-established company and the risk-reward is very attractive. For these reasons, I bought the stock, but remember that this is not financial advice and you should always do your own research. I hope you enjoyed the analysis. Let me know what you think about the company in the comments, and I'll see you on the next one.